that, or you can put it on the at 15.
No, it's going to be
All right, we are going to go ahead and kick things off. We got a good event today. Today we're going to break down the big beautiful bill, but what does that actually mean for entrepreneurs? And so today we have Marcus Bowman and Mark Wyzgowski. Sorry, I got it right? Wyzgowski. Sorry. Excuse me. So yes, before we kick that off, I see a lot of familiar faces, but I do this every time. How many of you all have not been to the EC before? This is your first time. Put your hand down. Okay, so I don't think I've met you formally before, but as always, what we want to do here is make Nashville the best place to start and grow your business by increasing the chances of success. And we do that by providing resources through our membership and our accelerator programs. And a little bit of what those look like. Membership comes with resources such as an advisor network of over 150 plus advisors, ranging from all different industry expertise and subject matter expertise. We also have startup curriculum through our idea stage, pre-flight digital course, curriculum through these events like this. So we have lunch and learns monthly along with capital sessions as well. So another capital session is going to be coming up tomorrow. I'll get into that after today, what that'll look like, what time. We also have the community of entrepreneurs. So plenty of ways to connect with other founders in the community through member directory, community Slack channel, events like these, discounts on startup tools, so many more things such as co-working space, meeting room space, and then we also have our accelerator programs. So you're going to see on the right-hand side over here, all these different banners. These are the current accelerator programs that we have. All of these are 12-week accelerator programs that based on your industry or your business stage. Now, how many of all are alum or a part of a program right now? Quite a few. I love to see it. Give a round of applause for our alum or our program participants. Yes, so we have takeoff for those at the early stages of their business, really in the ready to launch or early stages of their launch. We have in-flight for those at the growing and scaling stage, Twin Day for founders of color, Project FinTech for FinTech-focused founders, and Project Healthcare as well. All right, now, if you are interested and you're not familiar with some of the resources I talked about today, I would love to give you a tour afterwards. We can talk more in depth to see how we can support you. Thank you to our community partners. So everything that I've talked about already, we can't do this without our partners and sponsors. So we have our community partners, CompStasis for secure, reliable IT, and also Metro Nashville. We also have our growth partners. So special shout out to CLA. So Marcus and Mark are also a part of CLA. So very thankful for them. We give a special round of applause for them. So they are our accounting partner. We also have Pinnacle for banking, CLA for accounting. We already said that, sorry. Becker Donaldson for legal, RJ Young for tech, and Nashville Area Chamber of Commerce for community. We also have our supporting partners. Won't read them all off. Never will. There's too many. But as you can see, they are very supporting of us and what we do. Launch Tennessee. How many of you have heard of Launch Tennessee? It should be only maybe like 1 or 2 people that shouldn't have heard of Launch Tennessee. Sorry. If you haven't heard of Launch Tennessee, there's a QR code to learn more about them. So they specialize in capital, connections, commercialization. They have a lot of good programs. And then one of them being investing in. So if you were looking for capital, this is might be a really good option for you. So they have a regional seed fund in all sorts of different regions in Tennessee. Of course, one being Nashville. So if you want to learn more about this is an equity-based investment. And so they're a catalytic matching fund. So if you want to learn more about them, you can scan that as well. Anybody looking for capital right now?
Always.
Always, okay. So,
In a constant state.
after today, I'm going to explain our capital sessions so you can come check those out. Without further ado, I'm going to pass it over to Marcus and Mark, and we're going to get into today's topic. So I'll let them do an introduction, and they'll kick it off.
I need the clicker too.
You do need the clicker.
Thanks, sir.
No problem. Give a round of applause.
All right, thank y'all. Let's see, good afternoon, I guess, just barely. So glad to be here with you today. My name's Marcus Bowman. I'm a principal at CLA here in our Nashville office. In my career, I've been an entrepreneur. Actually, had a practice that I ran with a partner for 8 years in Washington State before moving here. So know and love the entrepreneurial world. Excited to be leaning in here at the EC and doing what we can to demystify some of this stuff and make it practical and applicable to you. So, Mark.
Thank you, Marcus. Mark Wyzgowski, principal with the CLA. I've been with the firm 26 years, so this is my actually 4th office with the firm, and kind of a unique story for CLA and coming to Nashville. We're in 130 markets throughout the country. Nashville was the first office that we actually just moved myself and another gentleman into town and said, hey, go build CLA in Nashville. So a lot of shaking hands, a lot of kissing babies, did a lot of that stuff for a number of years, and I was first here January 1st of 21, and we incubated in those conference rooms right there. CLA started Nashville's office over there, and we were there for 8 months before our office was ready. So again, love serving, love stories. So this is going to be, and Marcus will tell you, please make this interactive. This is otherwise very boring tax stuff. But there is a lot of value to be had. I love the story. That's why I love working with entrepreneurs, because everyone who sits in this room wants to make the world better by their idea, and they all want to leave a legacy. And even my robust businesses that I serve, those business owners' legacy is never the most I can take with me. It's always taking care of the family, the community, the employees. So I love the story, and so we'd love to get to meet you more during this conversation. And with that, we'll turn it over to the Bill.
Yeah, I'll just one more moment of setup here, which is we're going to make some assumptions today. This is a bill of what you said, Mark, 300 some pages.
331 pages.
So we're going to condense that down into a set of slides. Started with a list even that was a little bigger than this one, targeting what we felt would probably be most applicable to you. That said, there's a lot of noise, a lot of conversation about this act out there. You've no doubt seen some of it. So if there's an aspect of this that you feel applies to you and we're not addressing it here, that doesn't mean we can't talk about it. And if we're not smart enough to give you the answer, we'll find somebody who is. So with that disclaimer, we will get rolling. And please just raise your hands, throw in questions. We've got until 1:30, and we're not going to sit here and talk at you for an hour and a half. I promise you that. So please ask questions as we go, and we'll try to address them. All right, legalese, which I will not read all of, but basically, I guess I'll just say this. We're giving generic advice here. Everybody's situation is unique and complicated inherently by the factors that make it up. So please don't take anything here and assume it applies to you exactly as we say it. Always a conversation with your tax professionals in order when you're trying to apply something here. All right, so we're going to start with the individual tax provisions. Mark, maybe as we get started, talk about how the individual and the business worlds kind of blend together from a tax ramifications perspective.
Great question, and of course, a lot of you might be flow-through entities, meaning what you own is an LLC. You might be the sole owner of that LLC, or might be in a partnership. So all the business attributes and all the things we'll talk about later, all of those really impact your 1040, your personal income tax return. So the importance of the individual components is vitally important to your legacy. We talk at CLA about life cycle net cash. It's not just today's lowest tax bill, because sometimes that could shoot you in the foot for the future, but really understanding that what you do for the business, if it's a flow-through, and most of you probably will be under that regime, does impact your 1040. So this is going to be talking about what that does when it gets to that 1040 level first, and then we'll cover the business aspects later.
Perfect. So we'll just kind of hit these. Some of these we'll have more conversation than others. But Mark, start just tax rates. Talk about what happened with rates.
Sure, and I'd like to give context to the why behind a lot what you see on the screen. So if you might recall, in 2017 there was a tax act that lowered income tax rates. That was set to expire at the end of 2025. So this tax act has extended those rates now permanently. So I like to also boil it down into real numbers because I think that's important. So if this did not take effect, in 2026, if you earned $175,000, just earned income, nothing else, don't think of state and local tax deductions, don't think of the new standard deduction, just earned income, your tax bill would have gone up approximately $5,000 without these tax rates being extended. So everyone who pays tax, no matter high income, low income, middle class, has going to see reduced taxes because of this bill. So that's made permanent, which, as I mentioned, was set to expire at the end of 2025.
I like the idea of, because everybody has to file a tax return, right?
Well,
And-
you should. I do have a lot of people come in that haven't filed a
Everyone
tax
should.
return, and we don't want that.
Yeah, should likely be filing a tax return. Sometimes what we find is that tax relationships can be pretty transactional, and there's not a lot of education given around the tax return itself and what it means. So, I don't know, show of hands, if I say, standard versus itemized deductions, how many of you know, yep, I know exactly what that means in all its, okay, so I got 20% of the room. So Mark, as we're talking about the standard deduction being made permanent at a higher level, maybe cover the difference between standard and itemized at the same time.
That would be great. Again, standard deduction was increased based on the 2017 Tax Act, and it was supposed to revert back to a lower number. The standard deduction is the figure that the government allows each taxpayer, single individual is usually 1/2 of the married filing joint, that they can put all their income sources together, comes up with a number, and then take away the standard deduction. So that's given to you whether you own a home or don't own a home, itemized deductions, which we'll get into. So this basically makes it almost permanent at roughly $15,000 for a single, $30,000 for a married filing joint. All of my numbers are going to be general because there might be with some dollars, it might be $30,000, $56. Generally, it's increased that to that level going forward. So now let's move to what is an itemized deduction. So I own a condo that I own, I pay a mortgage. My mortgage, I'm single, my mortgage interest is $8,000. My real estate taxes are $6,000, and I pay $2,000 to charitable contributions. 8 plus 6 plus 2 is $16,000. On my tax return, I would get to deduct a $16,000 itemized deduction rather than the $15,000 that the government gives us as a standard deduction. So that's simplistically what the itemized versus standard deduction is. Yes.
How do you know which one goes to the itemized deduction and the one that goes to the Schedule C?
Well, that's a great question. Business use. So let's pretend you have your offices in your home.
Because you mentioned real estate, is that a property?
Real estate tax. No, that would be, this one in my example was if you owned your home.
Okay. The one
But-
that you live in.
Yes, but same question, pretend I am an entrepreneur, I don't pay for co-working space here, I work out of my home office. Well, if your home office is dedicated to your business and it's 1/10 of your total home, that percentage of the mortgage interest and real estate taxes would go against your Schedule C income, the 90% then would go to your Schedule A.
One
Yes.
discussion, so when you make your charitable deduction, of course, that, you're reducing the amount of taxes you pay, but, you're still giving up that money, so it's a decision, right? To give your money
Correct.
versus-
Yeah, all of this, yes. Again, what I think when we talk about
Deduction versus credit here, right?
It's a deduction, and what Marcus and I say is very rarely does doing anything to save tax dollars is the prudent decision. It can be if you need to get a new machinery for your business, but some people come into us and say, hey, I'm going to buy a new machine. I used to, long story short, I used to work in small town Illinois, had a lot of farmers. They love big tractors. And they love to buy big tractors every year, even though it's not going to increase their profitability $1. That's not a very prudent business expense.
But funding your retirement.
Funding a retirement, again, goes down to cash flow, because I always say that life cycle net cash flow, using money that I could use today that I have to go borrow to fund a retirement, again, big conversation, but it's, you know, in a vacuum, everything's got to, you know, be thought through. But the charitable deduction, to your point, if it's a philanthropic reason, because if you take the standard deduction, that charitable deduction doesn't help you. But again, it comes down to why you're giving that contribution.
Unless there was a new tax bill and then it did help you, even if you don't itemize.
We'll get there. What was your question?
Yeah, so you mentioned real estate and mortgage. What if you rent an apartment, you can put your rent in the standard deduction? I mean, itemized?
No.
Okay.
No.
So only mortgage and.
Only mortgage interest and real estate taxes for a principal residence. But your office in the home, you can put the rent against your Schedule C pro rata.
So that if you rent, you can use that as an office deduction.
Portion of it, yeah.
Yes.
For rent.
Yep.
And I'll just throw in a quick home office thing here, right? Because home office is not the corner of your dining room that has your table
No.
in it. Regular and exclusive business use is the language that the IRS uses. So really better to have an office space in which it appears that you only do business things. You know, you do what you mix the use how you want, but if somebody walks in there to look, and they're an auditor, for example, it needs to look like this is a business space, not a mixed-use space, because that could invalidate your deduction.
I just want to say quickly, I'm in a business that gets audited a lot, and I did get audited, and they actually, the person came and walked into my home, where I have my little office, and wanted to go into my private office downtown, and it was locked, and look around, and so they really, I was like, take off your shoes at least before you come in.
All right, so standard deduction versus itemized, you take the bigger number, right? Talk about we got a reference to charities here, and historically they haven't impacted us if we're not itemizing, but now.
No, taxpayers like the rule that this came during the pandemic. They did allow non-itemized, who make charitable contributions to deduct those contributions up to a certain limit. They have brought that back as part of this bill. So you do not have to itemize. So in my example, I'm a single person. I don't own a home. So I get a $15,000 standard deduction. I also give $2,000 to my church. I get to deduct that as well. I'm not through the standard deduction. That's in addition to.
Perfect.
Excuse me.
Yes.
If it's, what is the 2K, 1K? Is
A married filing joint, 2,000. Single taxpayer, 1,000.
if it's over 2K? Is that
Then you're capped. Yep, that's the most they'll let you take without itemizing is $2,000.
okay, but with itemizing, you can do.
Because that would be, yes, that's a good question.
Yep.
So if you itemize deduction, there's a whole bunch of limits on charitable contributions that were embedded in this new law.
Yeah.
But long story short, if you give $15,000 to charity, you pay mortgage interest of $15,000 and real estate taxes of $8,000, all of that would be $38,000 as an itemized deduction. So I hope I'm not confusing it. If you itemize, there's a little cap on charitable, but it's not those small numbers.
Yeah, okay, so if you're itemizing, it's
Whatever yes, 26, let me get my facts. In 26, they're gonna limit the charitable amount based on 0.5% of your adjusted gross income.
5.
So 0.5%, so if I make $200,000, 0.5% is 1,000. If I give 10,000 in charitable, I only get to deduct 9. Sorry for getting granular.
No, that makes
Yeah,
sense.
it's
But
very
I'm an entrepreneur, so like I'm not making money, but I'm using like equity and other investments to then give to charity. So I don't know how that would work.
Well, again, personal tax implication, if your 1040 doesn't show any income, that's just as a, air quote, lost philanthropic giving. It's not a tax deduction if there's no income to offset.
Got it, okay.
Excuse me, if you itemize, it would carry forward 15 years if you didn't use it, but I'm getting way too now.
You can see how complicated this gets individually, right? So we're speaking in broad general terms. We're happy to try to speak to your situation as much as we can, but just gotta be a little careful with that, because it's.
This is why you
it's
love
pretty
your
complex.
tax CPA and understand why
That's
they do
right.
bill you a little bit, because it isn't just putting a number on a form.
All right, so those three, and then this one was interesting. A lot of noise about this, but the implementation of it is maybe a little different than folks might have anticipated. Mark, talk about the tip and overtime pay exemption item.
Now, first off, if you've heard this is a fairly significant deal, especially for a lot of entrepreneurs that might be doing other things while they build their business, whether that's working for someone else, working as a server, bartender. You will now get if you get a W-2, and if you're a business owner and you're paying people via tips or overtime, your payroll processing provider will make these adjustments. But you will get a W-2 that states how much of your income was earned through overtime and or tips. It is then a tax deduction on your filed return to exempt up to $25,000 or $12,500, depending if married, filing jointly, or a single individual. So that's under certain income thresholds. So if you make $500,000, you're not going to get this exemption. But if you make $100,000, you could exempt $12,500, which is going to save you $1,500 to $2,000 a year in taxes. So again, that's a pretty, in my opinion, we do clients, startups to 1040s, just starting out. We do all sizes. And I know a lot of my clients might work for the trades. They're going to have overtime or servers, and they already get their tips reported. This will be cash in the pocket for those individuals.
Yeah, I think the thing I referenced that's maybe a surprise is with all the noise being made around, no tax on tips, no tax on overtime, and everybody's like, oh, that means I'll just take my tips home and there'll be no tax ramifications. Unfortunately, not quite like that, right? You still got to report the tips to your employer. And so we're doing some education both on the employer and the employee side to say the exemption comes on your filed tax return at the end of the process. Unfortunately, not at the beginning. We got a question back here.
Let's say we got some 1099s, we get a lot of tip info. One thing that I know that they're not going to know how to ask, but they're going to be curious about is, is there a change in the liability repercussions for unreported taxable tip income, or just now tip income now? Is there a liability change for unreported tip income?
No.
Okay.
No.
I don't think so. Unreported income is fraud, right?
We all know when it comes to tips.
Well, it does. There's a whole thing there.
None of my people are doing that. They're not reporting their tips out.
Well, what employers end up doing to avoid their liability there is just, collecting them all and pooling them rather than letting folks take them home, putting them on the paycheck, right? So there are things to do to work around that. But no, there's as far as I'm aware, no change in the applicability of tax to tips as an income source.
No, that's why it's, to your point, it's still reportable. It's still subject to self-employment tax. I mean, it's like a Medicare as the employer employee. It's just the federal income tax implication can be limited. Is there a question?
Yes, as an employer, I have an employee on an hourly wage. Am I required to pay overtime in the same week that they work it? So then what would stop me from, if I want to help my employee out, just say retroactively, hey, you worked this extra 200 hours over the course of the year, so here's that money, and now they're also getting kind of a bump because they get to take that off their taxes.
I can't give that question real advice, but I will say anytime you use the word going back to save a tax, that's tax avoidance, and things that are done by tax avoidance are deemed fraud. I'm a CPM licensed. I'm sure people find there's a lot of creative entrepreneurs in this world, but you came to me with that fact pattern and say, well, we probably need to fix that because I don't want you to. I'm the big fan of sitting across the IRS agent. I'll fight a gray area all day, but the dotting the I's and crossing the T's, we got to get that right, or we don't get any credibility by an IRS agent.
Just to clarify, this doesn't apply to this year, but next year. So it's going to apply when we file in April 2027.
I think that is a 25.
2025 tax returns, this applies.
Yeah,
$10.99 for the 6K going to.
Oh,
the next slide was.
Yeah, I'm sorry, you're jumping ahead of some slides. So we'll get to you here, and we'll answer that question. I think one more thing on the payroll question here, which is that I think generally speaking, from my understanding, I've spent most of my life in an outsourcing realm. those wages are pretty much due when the hours are worked within the normal pay period cycle. So you could have a couple of issues with that scenario. Again, we know people get creative, but I think if we're telling you what the law says, it's probably might not be the best strategy. So, okay, we're going to talk 1099 reporting thresholds now, Mark, because we brought it up.
Okay, we'll jump over the car interest deduction to that.
Yep.
And given your background, Marcus, this is a 2025 change to report?
That is my
correct?
understanding, yep.
Okay.
So historically, and honestly, I include this, and to me, this is a big deal for entrepreneurs because there's an awful lot of payments to contractors in the entrepreneurial world because you're not hiring employees, you don't want that burden, and so being able to exempt somebody that you've paid less than $2,000 in the calendar year as an independent contractor and not have to collect paperwork, W-9s, and then have to do 1099 filing. This saves some administrative burden and hassle. So I'm excited for the folks that don't have to do the reporting, and I'm excited for us not having to file so many 1099s too.
And another big change was the car interest deduction. So, showing my age, when I started practicing, you used to be able to deduct a percentage of credit card interest, car interest, that all went away in the Tax Reform Act of 1986, well before any of you were born. But now they're bringing this back for this limited time period, 2025 to 2028. There's 119 models with final assembly in the United States that if you bought those in 2025, and pay interest on it, you get to deduct that interest, and you do not have to itemize deductions to do it.
So you should finance the car for that deduction.
That would be a big question about what's your funds, where are your funds at, invested in, what's the rate of return versus the interest cost and the tax savings.
What they're incentivizing here, it appears, is the Made in America thing, right?
Yep.
So they're trying to give people some kickback for, and that's up to $10,000. That's $10,000 of debt, Mark, right? That you can deduct interest on. Do you know what that is? Not $10,000 of interest. That's a cap.
That would be. We'll need to.
Maybe something we can clarify for you here. Remind us if
I
we
think
don't
it's
remember to
interesting.
come back to it. Okay. All right. Good. Anything else on the car interest thing before we move along? All right. Look what I did, Bart. It's tips and overtime get
just
talked
second,
about twice.
The car interest deduction is for final assembled new cars. Yeah.
I was moving some stuff around. on
Tipping and
slides.
overtime is a big deal.
It is. So
we
we put it in here twice. That's on me. That is what I did when I was moving things around on the slides. Okay, let's talk about health savings accounts. This one's an interesting one, maybe a little nuanced, Mark. But health savings accounts are a great idea for entrepreneurs.
No, I would suggest
Generally.
back to the conversation about retirement plans and ways to reduce your tax obligations and do something for your future. Health savings accounts are very often overlooked. What you have to do to be qualified to be able to contribute is have a high deductible health plan, which anyone who has a insurance policy can find from their provider if they have a high deductible plan. But this act actually enhanced what plans qualify for the health savings account. So long story short, you can make a contribution up to a certain level, put it into an account. It's a tax deduction. You don't have to itemize. And you don't have to really use that money for medical if you don't need. This is where the cash need is. A lot of our higher wealth clients contribute to these, and they just let these things grow in essence until they're 70, 80, when they know they will have medical. Because then when you take that money out and pay for medical, all the money, the earnings, the contributions, none of it's taxed. So highly recommend considering an HSA, even if you put $500 in, if you have a taxable income, that's still a start. Yes.
That's great about leaving the money in, because I have, but could you use it for your premiums to pay them or no?
No, I do not believe. I believe it's for medical because it's because the insurance is paid through the high deductible health plan. This is to supplement you not having everything covered by using the cash from the HSA.
This is often the. I'm going to go on a little bit of a tangent here, Mark.
You go on.
Sometimes we find when we're talking to people about financial planning and their money, that people tend to overinsure the small risks and underinsure the big ones. Okay, and one of the things that will often come up in a review of a client's financial situation is that they're really not getting the benefit out of their low deductible health plan. And they would be better off going to a high deductible health plan with the health savings account, fully funding that, getting an upfront tax deduction for those dollars. It's often more tax efficient. Again, your situation is your situation, but it's something we see a lot of.
This might be a really dumb question. For full on 1099, like I'm in real estate, can I have a health savings account or no? Like, can you do a private one?
Yes. You have to have a health insurance plan that's a high deductible plan, then you can just find
What
a,
about healthcare sharing?
Health sharing is not going to make you eligible. So there's a lot of, you're talking about
Like legit.
those health sharing
Yes.
plans out there, right, where it's, no, those unfortunately not.
because you're gonna have to go to the HSA bank, because you get a form that
Right.
reports your contributions, you're gonna have to say what the plan is to be able to make that contribution.
Good question.
It's a great question.
Good
Because
question.
I have health sharing and I'm like, no one's ever told me about this option. That's not why.
I would think this would be worth looking at as somebody who's done medical sharing plans historically myself, and then our needs changed and we looked at and found that this was a more tax efficient way to go, because for the medical sharing thing, there's no tax aspect to that.
But even if you keep the money in there, but what if you do have, medicals that may not exceed whatever that percentage is to be itemized or deducted? Wouldn't it be better to still pay for it out of that because you're reducing your taxable income on some level?
Well, if you're not itemizing deductions for medical, there's not gonna be any tax deduction, whether you pay from out of pocket or from the HSA, and the HSA is already generating income that isn't subject to tax. Yeah, so it's not like it coming out like there's no tax, so you're just letting that 10,000, 20,000 accumulate, because it's never gonna be taxed when used for medical, if your financial situation allows you to pay for medical out of pocket.
So it's just, I'm from Europe, so this whole medical thing.
Yeah.
It's different.
Not gonna comment, but I mean, so this is because I hear things like life insurance, medical insurance, Roth IRA, 401k, so what is that compared to a Roth where I could, or a 401k that it says I could borrow the money for medical? My Roth says I could borrow money if I had a medical emergency.
Well, so this is, an HSA is out-of-pocket medical as part of a health insurance plan. So you mentioned some employee benefit plans, which are health insurance, disability insurance, Roth 401k, Roth IRAs, 401ks. Those are retirement vehicles.
Yes.
So this is a combination retirement vehicle and health insurance deal.
I think the,
I mean,
answer the
and when,
question-
borrowing to pay medical is fine, but you have to put it back. Or else-
So that's the big difference between those two, because I see just money putting into an account you can use for a medical expense.
Right.
How is that different?
Well, then a Roth IRA, you don't invest in a Roth IRA to pay medical expenses. That should be viewed as a retirement vehicle because of the power of that retirement vehicle. So this is just, hey, we have a lot of our clients put the money in, it's a tax deduction, and they know they're gonna spend it for medical during the year, and they take it all out, and at the end of the year, their HSA is zero. But they save the tax on the contribution. Because if you put $2,000 in a Roth IRA, you don't get a tax deduction.
Okay, so just because I need that concrete example. So I'm just gonna round it up. Say my medical insurance plan is $300 a month. You're saying I should open this as an account as like a brokerage account, put the 300 there, then take it out and send it to the medical?
No. Health insurance plan, you have to pay your health insurance. You gotta pay the premium. This is just an add-on for a high deductible health plan.
Yeah, I think I know we want to be a little careful, to not get too specific into your situation probably, but this is a conversation that you could certainly sit down and have with like even a health insurance professional, somebody who sells health insurance or a tax provider or somebody. could walk you through kind of the specifics of your situation, probably give you some better advice.
So this is not to pay the insurance, is to pay a bill.
This is to pay bills that your insurance does not cover.
Because you're in a high deductible plan.
Yeah, and just to add to that, my wife and I started doing this. I wish we did it years ago, because in HSA you can use for like all kinds of stuff. I mean, we use it for massages, for chiropractic visits, vitamins that you buy online, psychotherapy, yeah, acupuncture. I think we even use it to buy our like mattress. Like, I mean, you can use it for like a lot of stuff.
And they expanded it as well.
There's more stuff now that's eligible. Yeah, you made the point I was going to make, which is there's a lot of things your health insurance doesn't touch that you can pay for with tax deferred dollars here, or tax-free dollars, really.
Right.
Yeah.
And so there's a lot of reasons that this is a good idea for a lot of folks.
No, I don't understand it.
Okay, let's hit the last couple individual tax provisions here, and then we'll jump over into the business realm. This is an interesting one, the so-called Trump accounts. Just talk about that, because it's going to impact anybody who has a child here in the
Anyone who
next.
has a child that has a social security number, or one of the parents has a social security number and the child has a social security number, will get $1,000 from the US government. Yes, anyone born between 2025 and 2028 will get $1,000 into an account.
Into a retirement account.
Right.
So why is that? Why could that be a big deal? Because the power of compounding, if you're starting at birth with $1,000, could be really, really significant. That's could be enough money to fund college or a lot of other things. So
You can add to it. This is talk to a financial advisor about this versus a 529 versus whatever. But this is interesting. And so if you have a child and didn't know it, and you get $1,000 into account, this is why. And for our gamblers out there, bad news if anyone does gamble. This seriously is a bad news if you happen to win $40,000 on a slot machine and you wanted to try to use that 40 to make it 80 and you didn't, so you lost all that $40,000 that you just won. Well, you're going to pay tax on $4,000 because the government is saying you can only deduct up to 90% of your losses, capped at the winnings. So again, probably no one doesn't apply, but I have clients that go up to the mint. I get a bunch of 1099-Gs for gambling. They normally have losses that exceed or the same as the winnings. Well, now they're going to actually write a check on phantom income. They're out cash. Both sides, actually, this is one thing in agreement in D.C. It's trying to fix it, but that's kind of got second fiddle to what's called a shutdown. So I guess that might have to wait.
Yeah, so if you've got, if they don't get this fixed by year end and you've got losses that exceed winnings gambling in 2025, this could bite you for some portion of those winnings.
How granular does that get? Let's say you're sitting at a blackjack table. You're up, you're down,
Well, again, this would have to be reported. So
It's reported out on
it doesn't change the reported
G, yeah.
1099-Gs or W-2Gs that they have. That's never really captured. This would be like the slot machines, the sports betting.
Okay.
Anything that you get a W-2G that reports gambling winnings. So you would be limited to 90% of the gambling losses to offset it.
So for all you sports gamblers out there you go. All right. Well, let's hit some business tax provisions here. So these, again, everything impacts the personal return on a flow-through entity, which a lot of small businesses are. But these things are happening at the business level. So Mark, maybe let's just start left and work right here.
And again, qualified business income, QBI, that was basically, long story short, there used to be a manufacturing deduction. So if you're a manufacturer that you're profitable, you got a deduction of a certain part of your income. Back in a number of years ago, they changed the rules to basically anyone but health professionals, lawyers, and accountants, simplified, who are in a business that have a profit can deduct 20% of that net income and not pay tax on it. So simplistic thing, you're a company that generates net income of $100,000 and you're in retail. When you get to your 1040, That 100,000, you get to deduct 20% of that. So in essence, a $20,000 deduction. There's certain rules, but what this law did is it made this, extended it. It was supposed to expire at the end of 2025. So that's, again, that's a significant, because in essence, 1/5 of your income is not taxed.
Do they automatically give that to you, or
You have to fill out the 8990, you have to fill out the forms properly. That starts at the individual, that kind of reflects the income that's qualified, then it rolls into your 1040, and they have to be input properly on your 1040 to reflect that.
But your tax professional would
They would.
Yes.
They would. They should.
Yep.
Yeah, they probably will. One comment, because the why of some of this stuff is always kind
Sure.
of interesting to me. So my understanding is that the why behind this was really to try to kind of, with the C corporation rate at 21%, was to try to bring some parity to the small business owner not organized as a C. Is that fair, Mark?
Yes,
Is that
it's a way to take about 5% off of the tax rate to get it more comparable to a C corp.
Yeah.
And that was even pre-21%.
Yeah, that's right.
Is there an income, is there a cap on the gross income?
No cap. There are limits, again, very granular, limits based on wages, based on other factors, but if you're we deem a smaller business, there shouldn't be. Yes?
These were set to expire, but now, are these gonna be permanent changes, or like, do they have a year?
This one, I believe, is permanent.
Yep.
We tried to note in the slides which one were limited, 2025 to 2028, but again, caveat it, we could confirm that, but yeah, this should be permanent, or until the next Congress and President changes laws.
I was going to say permanent is permanent as long as Congress doesn't pass another law, right? So as permanent as it gets, it is.
I'm pretty sure my tax software does that calculation automatically, right?
Probably does.
But
I would assume, sometimes you might ask you a question, are you qualified or a specially service trade business? If you answer that wrong, you could
And then
shoot
there's
you in the
also
foot.
the wage limitation,
Wage,
right?
yeah.
So that, there are factors that would limit this deduction potentially if you didn't have certain types of expenses. So that's, again, why a tax professional is probably a good idea. Okay, bonus. This is kind of a big deal. Might be as big a deal from as there is if you talk to some folks.
Far right's the
Oh
biggest.
yeah, the far right one's interesting too.
But bonus depreciation, again, a number of years ago, Congress passed a law that basically said if you bought a piece of equipment to use in the business, you could write off 100% of it in the year you buy it. This was gradually coming down to be no longer the case. So it was at 60, supposed to have been 60% in 2025. This has extended it now permanently set 100%. So now if you buy a piece of equipment, you can deduct 100% of it. And this was only though for assets placed into service after January 19th, 2025. If it was bought before election or inauguration day, it would be at the old limited rates. But going forward, it's going to be at that extended rate. And then Section 179, which is kind of in unison with this, especially for businesses of your size. 179 is limited if you put over $4.5 million worth of equipment into service. So think large companies, then they would utilize bonus. But for folks in this room, they're kind of 6 to 1, half a dozen the other, unless you file in different states. All states treat these two deductions differently, whether they let you have them or they don't let you have them.
Yeah, so some strategy maybe on which of these makes the most sense for you in any particular situation. But both doing essentially the same thing, which is allowing that upfront 100% write-off of that machine, that tool, that whatever it is you're buying to help you make money in your business.
And I get this question asked a lot, even if you finance it. I mean, you don't have to write a check for the $10,000 piece of equipment. You can finance it, but you get to deduct the full $10,000 even though you haven't paid for it.
What happens if you're receiving subcomponents in and you're assembling it into a piece of equipment your company owns? For example, in my company, we're building laser projectors and then using them as a service as opposed to someone buying a projector from us. So I've now built a piece of equipment, but I was receiving in switches, circuit boards, that sort of thing.
Well, again,
Understanding that's
my gut is that it would be fine. You can't use an overhead rate for your labor that goes into it to inflate the cost of it. You would probably still take the labor. just as labor and not maybe embedded, but you would take the components, and when those components are ready for use, I would argue that you could take this deduction.
Okay.
However, I'm not signing your tax return, so talk to the person
Yeah,
who does.
that's right. You had a question too.
Can you explain why a business would go with a 100% bonus depreciation rate versus the section 179, like the $2.5 million limit? Is there a difference?
There is, yes. If you have investors that are passive, meaning just write a check, that 179 is not gonna help them. Because a passive investor, there's a requirement to take 179, you have to be an active participant. So if you had seed investors or folks like that, they're not gonna get any of the benefit from that section 179. That would be probably the most.
What about for like, just like hard equipment, no investors? Like if you're buying, so we sell commercial work trucks.
Okay.
We're trying to advertise to our
Sure.
customers to take advantage of 179.
Yep.
And we've been trying to figure out like what's the difference between the 100% bonus depreciation and section 179.
Again, my gut would say there's really nothing. However, if they do use those in different states, certain states don't follow 179, certain states don't follow bonus. So that's where the granularity of where they're filing could come into play, because we make that decision on our multi-state clients is, well, which states is it most advantageous? Which way do we want to go?
Yeah. Might suggest you put an asterisk by that and just say consult your tax advisor, and then you're good. You can say anything you want.
Fair enough.
All right, R&D. Yeah,
we have one
We
question.
have another.
Yeah, can you give can you give a concrete example of where would be more advantages to deduct in that year than to have a depreciation over seven?
It's facts and circumstances based on current year's income versus projected future year's income.
So is it to like try to lower the taxable income that year?
Well, depreciation, let's go to that commercial truck that we just talked about. That's a 5-year property.
Yes.
So if someone buys that truck for $100,000 from him, and that individual doesn't have any profit, that $100,000, if he takes it as a deduction, will carry over to future years as a net loss, but it's not gonna say FICA and Medicare if you're a Schedule C or a partnership. I'm getting very granular, so that's why you would not take the bonus or the 179, because you're not gonna save any current year, maximize the tax rate.
But don't they have a loss carryover?
But you're not, so self-employment tax. 15.3% FICA and Medicare tax. If I have a loss one year, I don't get to offset that loss against FICA and Medicare. So in my example, year one, we have $100,000 loss, tax is zero. Year two, we have $100,000 gain, I pay $15,300 FICA and Medicare. Whether I bought that truck and depreciated it or didn't, where if I would have not depreciated it in the year I bought it. Again, we're getting granular. It comes down to, see, all this, like I say, it depends, and you have to model. And normally it takes someone who's got understanding of the variances to do that model.
So I mean, if I have an LLC, I'm no longer considered self-employed, because I did have like a sole proprietorship.
Well, you are, if you're a single member, that's right on your Schedule C, nothing changed. That
That's
is,
still self.
LLC is not a tax designation, it's strictly illegal unless you add a partner, then it creates a partnership.
Okay, I was underestimating, Mark. I forgot how much work went into R&D the
No.
last 2 years.
Yes.
But R&D expensing being restored, this is a big deal.
Yep. And
Did you do expense limits?
what's that?
Oh, the section 179 expensing, we did.
2.25 million, based on purchases of 4.5 million. Anything up to that, you can deduct currently is 179, and bonus has no limit. You can't buy a building unless it's a qualified manufacturing property, which now has some
I think we mentioned that. I think we're gonna get into it. I think so.
Sorry.
No, yeah, you're good.
But the bonus or 179 is not applied to real property. So this building, it would apply to this projector, sound things, but not the building. In research and development, unforeseen impact of the 2017 Tax Act was that expenditures for research were no longer to be currently deductible. So I'll give an example. We're in a software as a service business. We're building an app or whatever it is you all build in that business line, and you spend a lot of wages. So you do have some other income, but in 2023, I spent $500,000 on wages building this app. I have $100,000 of income from something else, whatever. In 2022, the law changed that $500,000 that I paid those employees to do research is no longer deductible. I have to amortize it over 5 years. So if you can talk to people who are in this business, we have clients that are in the technology space that there are $13 million gross revenue, $3 to $4 million of their expenses to software engineers. In the 2023, they couldn't deduct, they could only deduct 1/10 of the $3 million that they spent. And then all of a sudden you have a phantom income. This fixed that. So going forward, any unamortized research from prior years is now allowable in 2025, or could be spread over 25 and 26 if the tax situation warrants it.
I have a question.
Yes.
Sorry.
I'm gonna,
But for the research and development, what if you're the one who did the development? So, I mean, can you like,
No.
so you can't pay yourself? You can deduct your own salary? I mean, so if I was to pay someone else to do
Yeah,
this.
well,
it would
again,
cost me, say, $100,000
if,
now.
as a single member LLC, you don't have a salary. That's another conversation for a tax advisor if, not saying Mark said to, if you should create a taxable entity like an S Corp or C Corp and pay yourself if those expenses would qualify for this credit and this deduction. That's another question, because as a sole member, you can't pay yourself a wage. So there would be no wages to put into the calculation.
I'm gonna insert something here real quick, just because I know we're about 10 till 1, and we've gotten till 1:30 technically, but if folks have to go, just get up and take off, don't sweat it, but we'll be here till 1:30 to answer questions or whatever. So, had another one.
On the R&D expensing, that would apply to, so for SaaS, for example,
Yeah.
we've outsourced to a development firm to build our SaaS. That would categorize as an R&D expense.
It would. It's limited, I think, to 70% of the direct costs to
Okay.
go towards the credit. Because again, there's the research and development credit didn't go away. That was the same. It's just they just got rid of the expenses that used to be able to be deducted. Were now amortizable. But outsourced or foreign outsourcing is at a lower threshold. But theoretically, yes, that would be captured.
Thank you.
Okay, let's keep going. I think these are, and Mark, I lied here.
Oh yeah.
So I apologize for that. I don't intend to do that. But let's do talk about the real property kind of components of the bonus depreciation. There was some special things done for manufacturing type facilities, right?
Right. If you're in manufacturing and you buy a building, you can now depreciate it or deduct it under these rules, which normally you have to depreciate over 39 years. And this is for anyone out there that owns maybe rental properties or Airbnbs. You know, this bonus depreciation, you might want to consider a cost segregation study, because let's pretend you bought a 4-unit in East Village or East Nashville for $2 million. That's 27.5-year property. It would take you to 27 years to get the deduction for it. But if you do a cost segregation study, they can bifurcate a lot of that cost to make some of it eligible to be written off in the year you bought it. So that's just something to consider if you do own property. Talk to a qualified company that does those things, because you don't want to spend $10,000 to save $8. But that is something to keep in mind if you're acquiring any type of real property. That cost segregation study might enhance your deduction.
And that's only, sorry, I didn't raise my hand. For manufacturing, that's only certain. You said something, there's a designation for the type of?
Yet I'd have to get there's very specific language as to what qualifies.
Yep. So some really interesting expensing, kind of upfront expensing provisions in this bill. All right, we're gonna move to our last two here, opportunity zones. This is probably mostly for folks who are exiting a situation, but let's talk about that briefly.
Well, a number of years ago, the federal or Congress created an opportunity zone regimen where basically people who have capital gains can invest in areas that are deemed needing capital to enhance themselves. That's an opportunity zone. So what you do is you defer your tax from your sale. Let's pretend you exited one of your businesses. You had a little nice capital gain, $1 million. You invest that into an opportunity zone. You wouldn't have to pay tax on that until these old ones are falling off until 2026, and any appreciation on that new investment would be tax-free. This expands that to 2027 and going forward. Again, mainly on the exit side, not as much about the startup side, but it is for qualified gains.
Are those zones as in industries or zones as in geographic regions?
Regions.
Geographic.
Geographic
Yep.
regions.
Yep.
And there's opportunity zone funds, if you have a financial advisor, they know which type of investments to place you into that. Just bring that up because it is a fairly significant change to a lot of areas that might have needed that capital throughout the country.
So Mark, if I hit it big in the market, I have a hot stock pick, and I end up with a great big capital gain from the sale of stock rather than sale of business, can I roll that gain into an
I don't
opportunity
know,
zone?
I'd have to look.
I'm
Yeah,
sorry.
we didn't plan that
We
question.
didn't plan that, I just put him on the
I
spot,
don't really,
so.
I believe, yes, I believe it's any long-term capital gain can be rolled, doesn't have to be from an exit. But don't say Mark said you can go in an op zone with a capital gain.
Right.
We did not script this
We did not script
presentation,
this.
so I just put him on the spot, and there's more nuance there. All right, let's, section 1202, qualified small business stock, maybe just a word or two on that.
No, I think it's important because this group, you'll hear this a lot. Because section 1202 is about qualified small business stock. It's a way that you, in essence, could start your business, scale it to under $50 million sales price, and basically take up to $15 million under the new law, tax-free, not taxed. Caveat that. C Corp has to be for 5 years. This tiers that you could own it for 3 years, you get a benefit 4 years, in 5 years. So don't go make a C election tomorrow because you're gonna sell, again, time and place, maybe the next round after there's a discussion, but you'll hear that a lot in your circles. 1202, well, that's again, someone buying your stock of a C Corp. And if I was your advisor and you were gonna buy your business, I would really hesitate to buy stock unless I had a bunch of contracts that were under that stock that I couldn't just start my own and just buy the assets. So again, it's more probably in the private equity realm. When they're buying an established business, they know they have investors that are putting the money in, they know they're gonna scale it up a bit. That's when this most normally is in play, but you will hear that all the time around entrepreneurs and especially tech entrepreneurs and others. 1202 is a buzzword, but just know it all depends.
A little bit of nuance to everything. Okay, good. I think that gets us through our provisions. We had some takeaways here on just one slide. I think that's the last. Yep. So I don't know if we want to, Mark, if you want to just talk through this on a real quick level, just to recap a few things we've already talked about.
Again, depending on circumstance, all of this stuff needs thought. If you have, let's just pretend you have a business or a job and you're starting something here at the EEC. Well, how do those marry together? It takes really understanding the implications of what you're doing with the full picture. So we are CPAs, we get badmouthed a lot for being not proactive and reactive. Well, a lot of it is people when you call and ask for a meeting and it's going to cost you a couple $100, they don't want the meeting. And I get it, but it's a complicated world, especially in what you're all trying to do. And if you find a value add partner that you can trust, that will provide more value than what you're paying them, because that to me is I get on my soapbox a lot. That's sometimes very much often overlooked because it's a cash out. I get it, but aren't we doing that life cycle net cash? And that $500 today saves me $40,000 next year. That's times EBITDA of 8. That's a $300,000 deal. But yeah. So anyway, take the proactive advice if someone wants to sit down and listen to your story and wants to be part of that story and helping you lead your legacy. Understanding, depending on your situation, again, if you have a job and itemized deductions, because of the charitable limits they're putting in for 2026 and the enhanced standard deductions, we're having some people doubling up on their charitable and the real estate taxes 1 year to itemize more and take the standard deduction the next. Cost segregation we mentioned, manufacturing property mentioned in section 1202.
There it is. I didn't lie. I knew I had it in there somewhere. All right, good. All right, well, that's it for us from a talking at you standpoint, and it's been good conversation and questions. We appreciate that. Any of the rest of this is on the table, so if you got a question about the tax bill we didn't address or something about your situation we can speak to at a high level, we're happy to do that for as long as you want to stick around. I don't know if Trey wants to do any closing out here, but.
You didn't fall asleep. I'm impressed.
Yeah, I mean, my head is still like, But does anyone have questions? Still got some time, so you all okay with answering a couple more questions if there is any?
My question would be, can I get the presentation?
Yes,
So
Okay.
that's an easy one.
Yes.
But it's for members, so members, you all have.
There's a
the
caveat,
recording.
yeah.
Yeah, exactly. So you all have the recording, so of course there's a lot of information, but great thing is, you can go back, watch it through, keep rewatching maybe 10 times to actually fully grasp everything. So that's a great thing, and you'll get the slides, yes. And then, thank you. Cool. So no further questions that you have right now?
I have questions. I always have questions. And were there any changes, this is like super specific to 412E3s or cash balance plans, were there any changes relevant with the new tax code?
Not that I'm aware of. The only thing that we really changed that we didn't bring up is enhanced child care credit, went up from 2,000 to 2,200. Nothing that I recall about any cash balance plans or things such as that.
And that's child tax, not child care, right?
Child tax
Yeah.
credit, you just get it
That's right.
$2,200 for.
Child tax credit, a little bit of a bump. I didn't put it in the slide.
Yeah, the Trump child thing, that was for new children or?
Yes, born in 2025 to 2028.
That's right. $1,000 in an account,
They're not yet born.
when they are.
Hey, get you through next election.
Well, family planning, all right.
Any changes to, I don't know, I guess crypto reporting or anything? Are you dealing with any clients right now that are getting income in cryptocurrency, Bitcoin, anything?
Nothing changed. Of course, there's a specific box you have to check on your tax return when you've disposed of that type of, but the tax treatment has not changed for that.
All right, give it up for Mark and Marcus.
If you have the presentation, if you're a member and you get it, and, yeah, I got you there, and you have our contact information here. So, or yeah, if you wanna do like she's doing, take out the phone and snip the contact info, that's fine. We're certainly happy to help. We're invested here in this community and committed to doing what we can to help. So please don't hesitate to reach out. We're happy to have a follow-up.
All right, thank y'all so much. Very, very thankful for you all and what y'all do for the community. Appreciate the opportunity. Yeah, absolutely. All right, now, before everyone starts packing up, just a couple closing announcements. Up next, we got plenty of things going on in the community. So we have our capital session that I spoke about earlier today, how to be pitch ready. So we're gonna have Peter Swan from Gust talk more about, or really just hear from you all and your pitches and get expert help from them. From him on a more investor-facing approach. So that's gonna be tomorrow from 2 to 4:30. We also have our NEC happy hour and trivia. It's gonna be in here from 3 to 5. That's gonna be October 16th. Opportunity to win trivia for a 50% discount on your membership or a new membership. And then our next awards Hall of Fame. That's gonna be October 20th from 5:30 to 9 p.m. Members get discounted tickets, so we have balcony seats, floor seats. You are eligible for those discounts. Think of this as the Oscars for Middle Tennessee entrepreneurs. The quickest way to explain it, we have a bunch of different industry categories, and within those, winners for a growth stage startup or growth stage business, and then a startup stage business. Startup being less than 5 years, growth being more than 5 years. I don't know why I have this in my hands still. Then we also have our elevator pitch. So another pitch-focused event. So this is a more collaborative environment. So if you want to practice either your elevator pitch or your full presentation pitch, great chance to do so. It's really just a nice vibe to it because you have no pressure. It's just a chance to continue to improve your pitch. That's going to be October 23rd from 10 to 11:30 a.m. Lastly, another capital session. This is gonna be our last capital session we have. So it's gonna be about building with the exit in mind. So what should that look like as you build your business in the beginning stages, but then how to apply that to when you wanna exit your business. That's gonna be October 23rd, another 2 events that day, packed from 2 to 4:30. So you can check out these at ec.co/events.
Trey,
Yep.
thing tomorrow, what, is that the focus more like your content or your numbers?
So it's gonna cover everything. So as far as like what slides look like, and then the content that investors are gonna mainly look for in your pitch. Yeah. Last thing, if you wanna stay in the know of everything that we have going on here, easy way to do so is sign up for our newsletter. So our 411 newsletter, 4 events, 1 lesson, 1 win. You can use that QR code right there. And then what'd you think about today's event? We wanna know your feedback, want to continuously improve these events. So please, if you would want to fill that out, let us know how we can improve, or what did you like? So we can continue doing that as well. But that's all I got. Thank you all for coming, and hope to see you tomorrow.